Importance of capital market. 1. Mobilizes savings. Instead of keeping money idle at home, the capital market gives people productive ways to invest their savings and earn returns. 2. Helps industries grow. Industries get the long-term funds they need to buy machinery, expand capacity, and increase production to serve more customers. 3. Economic growth. When millions of savings flow into productive companies through the capital market, the whole economy grows, jobs are created, and incomes rise. 4. Technological upgradation. Companies that raise funds can invest in research, development, and new technology, making their operations more advanced and competitive. 5. Stability and security values. A well-regulated capital market with expert intermediaries keeps security prices stable so investors do not face sudden shocks or crashes. Functions of capital market. 1. Link between savers and investors. The capital market connects people who have extra savings with companies and governments that need money to invest and grow. 2. Encourages savings by offering attractive options like stocks, bonds, and mutual funds. The capital market motivates people to save more instead of spending everything. 3. Encourages investment. Lower interest rates and multiple avenues for borrowing encourage businesses to invest confidently in new projects and expansions. 4. Promotes economic growth. Resources are rationally distributed to the most productive sectors, expanding trade and industry across both public and private sectors. 5. Stability in prices. The capital market reduces wild price swings by providing capital at lower rates and reducing unproductive speculative activities. 6. Benefits to investors. Investors can track their investments daily, buy and sell freely on the exchange, and are protected by SEBI from fraud and malpractice. Role of capital market. 1. Mobilization of savings. Activates idle money sitting in homes and puts it to productive use in sectors like agriculture, industry, and infrastructure. 2. Capital formation. Mobilized savings are invested in new factories, machines, and projects, adding to the existing productive assets of the economy. 3. Investment avenue. Gives people who want to invest for a long period many options like bonds, equities, and mutual funds with returns in interest or dividends. 4. Speed up economic development. Long-term funds available through the capital market help businesses do R&D, generate employment, and build infrastructure for the country. 5. Proper regulation of funds. SEBI ensures that capital flows only to genuine and credible businesses so that investors' money is always put to good and verified use. 6. Continuous availability of funds. The stock exchange operates every working day so buyers and sellers can transact anytime, ensuring funds are always available. Players in capital market. 1. Fundraisers, companies that raise money from domestic and foreign sources through shares, debentures, and bonds to fund their business activities. 2. Fund providers, investors who supply money to the market, including retail investors, mutual funds, foreign institutional investors, and NRIs. 3. Intermediaries, middlemen like stockbrokers, merchant bankers, underwriters, and portfolio managers who connect fundraisers with fund providers. 4. Organizations, stock exchanges like BSE and NSE, and depositories like NSDL and CSDL that provide the platform and infrastructure for all market activity. 5. Market regulators, SEBI, RBI, and the Department of Company Affairs set and enforce rules to ensure fairness, transparency, and investor protection. Types of capital market instruments. 1. Debt instruments, bonds and debentures where investors lend money and earn fixed interest. Investors get top priority if the company goes into liquidation. 2. Equities, shares that make you a part owner of the company. Higher risk but higher returns. Equity holders are paid last in case of liquidation. 3. Preference shares, hybrid instrument, paid before equity holders but after debt holders. No voting rights, but receives a fixed dividend like interest on bonds. 4. Derivatives, instruments like futures and options whose value depends entirely on an underlying asset like a stock, bond, or commodity. 5. Mutual funds, a pool of money from many investors managed professionally and invested in a mix of stocks, bonds, and money market instruments. Primary market. The primary market is the market where new securities like shares and bonds are issued and sold to investors for the very first time. The word primary means first. So this is where a security is born and sold publicly for the first time. Companies, governments, and institutions use the primary market to raise fresh capital directly from the public without involving the secondary market. The money raised goes directly to the company issuing the securities, unlike the secondary market where money moves between investors only. For example, when Zomato launched its IPO in 2021 and sold shares to the public for the first time, it used the primary market. Features and significance of primary market. 1. New issue market, also called the new issue market because it is the only place where securities are sold by a company to investors for the very first time. 2. Company sells directly. In the primary market, the company itself sells securities directly to investors and receives the money straight into its accounts. 3. Used for business purpose. Companies use primary market funds to set up new businesses, expand existing ones, or modernize their operations and infrastructure. 4. Facilitates capital formation. By turning household savings into productive investments, the primary market is the main driver of capital formation in the economy. 5. Government raises funds. The government issues bonds and bills in the primary market to raise money from the public for building roads, schools, and public projects. 6. Promotes business expansion. Both domestic and foreign companies can use the primary market to raise growth capital and expand their operations across new markets. Functions of primary market. 1. Organization. Before any issue is launched, the nature, size, timing, and method of the issue are carefully planned and structured by merchant bankers. 2. Underwriting. An underwriter guarantees to buy any shares that the public does not subscribe to, ensuring the company always raises its target amount. 3. Distribution. Brokers and agents spread the new securities to investors across the country through their networks, lists, and direct outreach. 4. Household savings. IPOs channel the savings of ordinary families into companies that need growth capital. More IPOs mean a healthier economy. 5. Global investments. International companies issue ADRs listed on foreign exchanges, allowing investors to diversify across global markets easily. 6. Sale of government securities. The government sells bonds and treasury bills directly to citizens through the primary market to fund infrastructure and public projects. Players in primary market. 1. Merchant bankers manage the entire issue process, from planning and pricing to underwriting and marketing. They are the main advisor to the company. 2. Registrars handle all paperwork, collect applications, maintain records, assist in share allotment, and dispatch certificates to investors. 3. Underwriters guarantee to purchase any shares the public does not buy, protecting the company from falling short of its fundraising target. 4. Collecting bankers, banks that collect application money from investors across multiple cities during the subscription period of an IPO or bond issue. 5. Debenture trustees protect the interests of debenture holders by monitoring the company, inspecting accounts, and enforcing security if needed. 6. Portfolio managers manage a client's investment portfolio on their behalf, making decisions about buying and selling securities as per the client's goals. Types of issues in primary market. Part A. 1. IPO, initial public offering, when an unlisted company sells its shares to the public for the very first time and gets listed on the stock exchange. 2. Why companies go public, to raise funds for expansion, finance working capital, provide an exit for existing investors, or reduce debt obligations. 3. Benefits of IPO. Access to larger capital, easier to raise future funds, shares become liquid and tradable, company image and visibility improves. 4. Disadvantages of IPO. Company must disclose financial information publicly, existing shareholders face dilution, and there are high costs of compliance. 5. FPO, follow-on public offer, when a company already listed on the stock exchange makes another public issue to raise additional capital for new projects. Types of issues in primary market. Part B. 1. Rights issue new securities offered first to existing shareholders before the public, in a ratio based on how many shares they currently hold. 2. Advantages of rights issue, very economical, no underwriting or brokerage costs. Existing shareholders get first right to benefit if the company is doing well. 3. Disadvantage of rights issue, only existing companies can use it and subscription is limited to existing shareholders, so it cannot reach new investors. 4. Preferential issue, fresh shares issued to a selected group of investors who get priority in dividend payments over ordinary shareholders. 5. Private placements, securities sold privately to a small group like mutual funds, banks, or insurance companies without going to the general public. 6. Advantage of private placement, no underwriting or publicity costs, company chooses its own investors, faster access to capital and less regulatory burden. Secondary market. The secondary market is the market where already issued financial instruments like stocks, bonds, and options are bought and sold between investors. The word secondary means coming after the first. So this market operates after the primary market has already issued the securities. The company that originally issued the securities is not involved at all, only investors buy and sell among themselves here. It is also known as the stock market or stock exchange and is essential for providing liquidity to all previously issued securities. For example, when you buy shares of Reliance from another investor through the BSE, you are transacting in the secondary market. Features and significance of secondary market. 1. Creates liquidity. The most important feature, it lets investors convert their securities into cash at any time without waiting for maturity. 2. Comes after primary market. Securities are always issued first in the primary market and only then listed and traded in the secondary market. 3. Has a specific place. Trading happens on the stock exchange like BSE or NSE. 2. Individuals can also trade directly, but most transactions go through the exchange. 4. Instant valuation. As soon as company news hits, its share price changes in the secondary market, giving everyone an instant and honest valuation. 5. Ensures fair dealing. SEBI regulates all secondary market activity to protect investors from fraud, manipulation, and unfair trading practices. 6. Induces companies to improve. Since share prices reflect performance and are visible to all, companies are always pressured to perform better and grow. Functions and role of secondary market. 1. Marketplace for stock. Provides a regulated platform where millions of securities are freely bought and sold every day through authorized brokers. 2. Ready and continuous market. Stock exchanges run every working day, so investors always have access to buy or sell without any interruption. 3. Mobilization of savings. Attracts people to invest their savings in securities by showing them that their money can grow and be retrieved when needed. 4. Capital formation. Successful companies with rising share prices can easily raise fresh capital, funding new projects and growing the economy. 5. Economic barometer. When the Sensex rises, it signals economic growth. When it falls, it signals trouble. The market reflects the health of the country. 6. Speculation. Speculators who trade to profit from price changes actually provide liquidity to the market, making it easier for all investors to exit. Primary market versus secondary market. 1. Other name. Primary market is called the new issue market. Secondary market is called the stock exchange. 2. Nature of securities. Primary market deals with new securities issued for the first time. Secondary market deals with already existing issued securities. 3. Who sells? In primary market, the company sells directly to investors. In secondary market, investors sell to other investors, company not involved. 4. Flow of funds. In primary market, funds flow from savers to companies, promoting capital formation. In secondary market, funds flow between investors only. 5. Price determination. In primary market, prices are set by the company's management. In secondary market, prices are decided by demand and supply. 6. Purpose. Primary market creates new long-term instruments for investment. Secondary market provides liquidity for those already issued instruments. Thank you. For skill development questions, refer to Chapter 5 of IFS. If this helped you, like, share, and subscribe to Riaz Notes.